Hello and welcome to Big Deal. Now, the tax bonanza that has been given by the government to corporate world will definitely lift the sentiment. But there's another important measure which we are going to talk about today and address on Big Deal, which is how to address the debt issue of the companies, which is, remember, also a big worry for the economy and the government. Now, the Reserve Bank of India has released a consultation paper on the secondary debt market and to improve that, which may give an impetus to foreign funds eyeing distressed assets in the country. Joining me, experts for this discussion are Nisha Poddar here in the studio, Bhavin Shah and Ashish Khandelia joining us from our Hyderabad studio. Gentlemen, so good to have you on CNBC TV 18. Now, Ashish, taking it to Hyderabad first and starting with you, how important is the development of a secondary debt market in the country?
Yeah, Nisha, I think it's really the need of the hour at this point in time, especially. I think it is just generally important. Globally, all large economies have gone through that. And they started with banks mostly lending to corporates, and slowly and generally speaking, in times of recession, measures have been made which allowed these loans to be transferred from the balance sheet of banks to several market participants, whether it is insurance companies, whether it is hedge funds, whether it is pension funds, and so on and so forth. And where we really sit today, I think we have been trying hard for many years to really create a bond market, to create a market for loans, but it hasn't really happened. So today, if we look at it, especially with our fragile balance sheet, not only of the banks and now of the shadow banks, all the NBFCs as well, measures that will allow us to attract smart capital, that will allow us to actually attract risk capital and not capital only for AAA and AA bonds, which is really the case today, is pretty pertinent. I mean, by certain different measures, there is about just, let's say, if we were to talk about the real estate related sector and that loan, which has been in the press all the time about causing stress on balance sheets, by some measures, it is about more than $50 billion just on the shadow banks or NBFCs. And, I would quote a Goldman Sachs report which talks about $10 billion out of that, or almost 20% could be in stress. Now, where is that capital going to come from really if we are unable to find efficient market-based mechanisms to transfer these things to people who are willing to take risk, like credit opportunities funds, foreign hedge funds, and so on and so forth. So I think it's pretty important. I think it is a great thing that RBI has taken this measure to institute this committee and call for this report, which I think has made some pretty interesting recommendations that I think we should certainly dwell into.
All right, taking off from your point on the recommendations, Ashish, Nishal, coming to you, what are the big recommendations and will they really troubleshoot the main bottlenecks for this market?
Sure. So the biggest recommendation in my view is allowing new entrants in the market. So the way current market function, there are only 4 parties which are involved: the banks, HFCs, NBFCs and ARCs. Yes. And all of them are facing liquidity issues today. So you need somebody as liquidity provider, right, so that these 4 categories of participants in the market can get liquidity, which is why Reserve Bank of India has proposed that will make the market more attractive for foreign portfolio investors, for alternative investment funds, for insurance companies and provident fund. So these 4 new entrants who actually have the real money will be able to give much needed liquidity in the sector. Right. And that is the first major recommendation, where specifically for foreign portfolio investor, RBI is proposing that there will be a requirement, they will be able to buy loans directly rather than coming through a securitization trust or through an ARC. Right. So that's a big change.
So one step is
eliminated.
Yes, yes.
The second major recommendation is for alternative investment funds, insurance companies and provident funds. Yes. They will be able to also acquire loans. Right now, they're only permitted to invest in debentures or bonds. Right. So it's one more change which has been proposed. Right. The third change is on the standardization of the documents. Right. So given that so many loan transactions are going to happen, if the documents are standardized, then there are no issues on negotiation of the documents. And the fourth major change is there is going to be a central loan registry and a self-regulatory body which is going to take care of all the records which can be digitized, and everybody can have access to the records with respect to the loans in public domain. Right. So I think these are broadly the 4 major recommendations which are there. in the report.
All right. So, Nishal, talking about these recommendations, it's very clear that what has been suggested really attacks some of the issues like, many layers through which they have to go, which has its own troubles.
Correct.
Also widening the overall debt market and also giving it a uniformity, certainty and transparency.
Correct.
Right? But at a time, Bhavin, and jump in on this, we have just managed to broad base our equity market. The participation of various types of investors has just been included. It's a recent phenomena. Do you think that, the debt market will also manage to take that way very soon? And when you really look at some of the aspects, some of the examples of these deals, how big a trouble is it today if these recommendations are not formally notified?
Yeah, so I'm clearly bullish. There's a lot of effort being made both by the government, RBI, and clearly there's a lot of opportunity which is sitting in India, which the foreign investors are currently eyeing on. As regards the changes proposed, if they're not done, means currently there's so many transactions which are in the pipeline. One big example that I can give is there's a transaction which is where the investor is ready to deploy a lot of money to buy a very large pool of bad loan in India. The banks are willing to sell that for a particular agreed price. Also, there is coordination across all the industry players. Now, the way currently our regulations are structured is that this loan has to be bought through an asset reconstruction company trust in India.
Right.
And asset reconstruction company has to fund 15% of that particular size of the transaction.
Yes.
There's no asset reconstruction company in India who would want to, at the price which is agreed, risk that 15%, and the capital also constrained. Now, the question for the foreign investor is that why do I need to go to asset reconstruction company? I have done the deal directly with the bank. Just let me do directly the deal with the bank, right? And exactly the report has suggested that just eliminate intermediaries which are not necessary. Asset reconstruction company in India has a role to play. Means if they identify or source the transaction, if they have an ability to resolve the transaction, of course, all the clients will go to them, right? Or to have their support. But don't force people to really have intermediaries in the transaction.
Right.
So that's the point.
So yeah, lack of funds and restrictions of that layered system where ARCs may not have the ability to fund in the intermediate process. That's one of the big concerns. So Ashish, do you think there is enough traction for this market amongst the foreign players? Do you think that if these bottlenecks are done away with, there would be many who could really line up in India to take care of the distress situations?
I think so, Nisha. I think there is a lot of interest in people who want to do these transactions, right? I mean, if I were to just quote, and this is reflecting back on some of the recent transactions that we had been involved with, effectively what ends up happening is you almost sometimes end up spending about 70-75% of your time really to figure out legally what is the way to enter into it. Probably negotiate endlessly with certain other conduits that you need to make part of the transaction, as Bhavin just pointed out, right? And really sometimes what it does is it elongates the time of the transaction too much. To one, the effort is intense. Secondly, the certainty of transaction happening is low. And then in a dynamic environment, in a fragile environment like this, as transactions take longer, sometimes during that period of time, some of these companies do get in deeper into the hole, and which makes the transaction either just completely go away or it has to keep changing the character. So if we are able to implement some of these recommendations, which are very positive, I must say, to remove some of these conduits in between, to remove the capitalization requirements from people who are actually not that well capitalized in India right now, I think it will really allow a lot of this foreign capital to shift their energy towards actually consummating transactions, making them happen more fast. Also people always look at their effort versus the certainty of actually getting that money out and invested. And today that certainty ends up being a bit low, not so much only because of commercial issues, but also because of these. And if they go away, it will certainly accelerate the whole pace of this foreign capital coming in.
Right, so regulatory hurdles, legal hurdles, very important aspects to really focus on. And also, Nishchal, time value of money is also very important. While we talk about value maximization, it's also how quickly the money flows in. Now, you would agree with me that there have been some instances where a distressed company has taken loan or funds by way of securitization from a foreign fund. How easy or difficult had that process been? What were the practical problems there?
Sure. So in fact, what happens is a foreign investor is sitting with money. In an ideal situation, if the bank or NBFC or HFC are willing to sell their loans to the foreign investor, it should be a simple transaction where money flows to them and the loans are acquired by the foreign investor. But what happens in reality is, from a legal perspective, the first step the foreign investor has to take is to set up a foreign portfolio investment entity, which takes about 4 to 6 weeks' time. The second is, depending on whether those loans are good loans or bad loans.
Yes.
If they are good loans, then you can do a securitization transaction. If they are bad loans, you will have to buy it through ARC.
Yes.
So in a good loan transaction, first the HFC or the NBFC has to comply with the securitization guidelines, which prescribe multiple requirements for the transaction to be eligible for lower provisioning. So one is minimum holding period. The loan should have been held for a minimum period. Then there is a minimum retention requirement.
Right.
Minimum certain percentage has to be held by the originator.
Right.
And because of all these compliances which are required,
Right.
sometimes what happens is that the originator is not able to meet with all the requirements required for securitization. And then there is a provisioning of 667%, which they have to do, where on one hand they need liquidity, so they may have to do the transaction, but on the other hand it takes a big hit to the P&L account of the originator.
Right.
So one is you set up an FPI, it takes, let's say, 4 to 6 weeks. Then to do this transaction or sale, comply with the securitization guidelines.
And different state approvals are also required?
That's the third issue, where the mortgages need to be recreated in favor of the securitization trust or the ARC.
Right.
And there, it's not just about going to each registrar in each state to get it recreated, but also the stamp duty. The stamp duty in each state will be different. So you are not only dealing with multiple stamp duties, but multiple sub-registrars for recreation of mortgages, and the entire process becomes very, very painful, especially in situations where the NBFC or HFC, have a presence across various states.
Right.
So multiple hurdles have to be crossed, which seemingly it looks like a very simple transaction, but the timelines get stretched because of these issues.
So ease of deal making is extremely essential
Absolutely.
if we have to attract foreign capital,
Absolutely.
especially. But Bhavin, there are tax implications as well and tax hurdles. What are those, and have they been taken care of in the recommendations in the consultation paper?
So the recommendation actually is mainly on the RBI report, so it does not include tax recommendations. But the committee has also spoken about some certain other agencies like SEBI and IRDA, etc.
Has given direction.
But for
that.
tax, it's actually silent.
Right.
And tax is a very important aspect in consummating a transaction, and a lot of discussions happen on tax. So one important thing which probably the regulators and the finance ministry should consider is that we have 5% tax on ECBs.
Right.
We have 5% tax on FPIs who invest by way of NCDs. But for this NPAs, where the large capital is required, one could consider again giving a 5% tax rate as against currently keeping it open, where the tax rate ranges from 10% to 40%. So if an investor is coming from Cayman Islands, he will pay 40% versus a investor coming from, say, a treaty country, he'll pay 10%. So that's the disparity which can be really eased out by having a fair rate, which would give an impetus to this.
All
I
right.
think just to add to what Bhavin said, it's a no-brainer, because today more than 85 to 90% of foreign capital which comes through private equity or private debt, right? The total capital in India, 85 to 90% is foreign money, right? So the entire regulatory and tax regime has to be conducive for foreign investors if we want to really solve the NPA problem, which the banks and HFCs and NBFCs are facing.
All right, taking the burden off our banking system, our NBFCs and HFCs, which are really saddled with their own issues, is the need of the hour at the moment. And we are discussing the theme on broadening the secondary debt market in the country. Nishchal, Bhavin, as well as Ashish, stay on with us. We'll slip into a short breather on Big Deal, but come back with more discussion on good loan, bad loan situations. Stay tuned.